2024. The Bank of Canada has reduced the key interest rate at consecutive meetings and is likely to continue through the balance of next year. We have 2 months left of summer and a whole lot to look forward to. I'm joined today by my fellow co-hosts, Sean Humphreys, Kristen Vetrano, I'm Vaughn Zawadzki, and we're mortgage people. All right, welcome to the show.
Hello.
We're going to kick things off by talking a little bit about there's a concept that I continually hear about buyers waiting on the sidelines and what are they waiting for. And to me, I think what that implies is that they have the ability to get into the market and they're choosing not to. And based on what I see in the market, it doesn't look exactly like that. And we have other comparisons, like for example, like Northern Ontario market and Calgary market apparently are pretty hot right now. So that would suggest that people aren't waiting because they choose to wait. It suggests to me that they're waiting because they don't have the resources to get into the Toronto market. And so I want to do a little comparison. When we look at the qualifying rate a couple of years ago, it was 5.25 issued by the Bank of Canada. And so the rule there is the greater of your contract rate plus 2% or 5.25%. So when we're in the low rate environments of like your contract rate being about around 2%, even 3%, everybody had to qualify at 5.25. And so what does that mean? Looking at a case study of let's say an individual that makes $100,000 a year, 2 years ago would have been able to qualify to borrow $480,000 in mortgage amount. In today's environment, they can only qualify for $400,000 in mortgage amount. But that doesn't fit with the pricing of condos in the GTA. So I would suggest that buyers right now, specifically in the condo market, simply do not have access to the same amount of financial resources that they did 2 years ago. And so we have potential solutions if and when interest rates lower below 4.5%, then we're going to be able to qualify people at 5.25 again, and they'll have access to that money. Alternatively, who's going to take an $80,000 haircut on a condo that they want to list? Who wants to weigh in?
People maybe don't want to take a haircut, but also maybe just can't. Like, if you're looking at resale, I mean, potentially investors maybe could, because they maybe have other cash to be able to pay someone to sell, for example. I wonder if we're going to be seeing more private sales for condos because then they don't have to pay realtor fees, for example, if they don't have enough equity after that mortgage. But if you're talking about people who bought, if you're talking about that customer that you sort of identified earlier, that $100,000 first-time home buyer, who presumably bought at least 80% loan to value or higher, they don't have enough equity to sell at such a loss anyway. So yeah, I mean, maybe this is a conversation for later, but like this does seem, when no one has money and things are falling apart, where do we look? We look to the government.
I'm going to take a different take. I don't think that income has almost anything to do with it. I think it's very loosely correlated to the purchase price. As things are taking off in previous housing bubbles, income has not been a good correlation to what people are purchasing. I think that I think that buyers are just nervous. I think they're seeing everything else cost a lot of money, and I think they're holding back in big purchases. We're discounting in that line of thinking that people don't make enough money, they can't afford that. We're forgetting about the bank of mom and dad who are just piling in the money to help people get into the market. Now, maybe mom and dad aren't feeling as flush these days, and they don't have the same amount of down payment or equity in their home. Maybe their property value has been going down, or they're not feeling confident. Maybe they're not sure where they're going to move, or if they have that money. And so they're holding back some of those resources. But I think overall, just the sentiment is things cost a lot of money. I'm not feeling like I have a lot of money, and I'm not going to be making a purchase with that. So
I mean,
I really
interest
think that
rates.
income is secondary.
I mean, I completely disagree, but I mean, I can agree with the sentiment that um, mortgage payments at today's rates are massive and they're frightening. So if you think about buying a $600,000 condo and you think you're going to pay $4,000 a month or something like that in your mortgage payment, it seems absolutely ridiculous. So that's enough, I think, to cause apprehension. But also, we know that the data, we're not building as fast as we should be. New home starts are down like 20-year record lows. Even the condo developments have stalled. So we know that condos in 5 years from now are going to be way overvalued. So there's a great opportunity for people to get in now and renegotiate a rate and a payment later when interest rates come down. I mean, that's what the savvy purchaser would do. I'm suggesting that they can't even do that because they can't get access to enough funds to actually pull the trigger on a purchase.
Yeah, I have at least one
Situation could be
first
if
time home buyer who is like can find something reasonable, can afford it, is like the monthly payment is right at the top of her threshold. So she's not super comfortable about that. And she's not super stoked about the volatility of the condo market. She's looking at how people are now in the position where they don't have equity, prices have depreciated. She's like, is this even a good investment? And we, of course, have been drinking the Kool-Aid for however long about real estate. I firmly believe that real estate, especially in a city like Toronto, is always going to be solid in the long term. But people have nerves right now. We have seen, it's that thing where we're just constantly living in unprecedented times. We're living through so many unprecedented
Yeah,
events.
can we get back to precedented times?
Yeah, let's do
Where there's a
precedented.
bit of stability.
Yeah.
When was that? Because last I
I
remember,
love
we were in a housing bubble, right? Precedented times is now property values going up, 10% year over year or more. Like, that's not healthy. The 40-year
Yeah.
average is 6.8% since the 80s. So I don't see how many more buyer's markets we're going to get. I understand that,
No.
people can't afford it, but this is a buyer's market. It's only going to get worse. It's not like it's correlated. Income is all of a sudden going to keep up with the pace of housing. I just think that it's always an emotional decision when we're going up in a bubble market, when people are day trading homes month to month, they're buying it and then they're selling the right to buy it for $100,000 more. That's not related to income whatsoever. That's just related to people being worried that they're not going to be able to buy something. Now it's the emotional way the other way, where people, well, there's lots of them. Is this a good investment? People were never really thinking that when prices were going up. They were just
Yeah.
showing up with the biggest
Nobody
pile of
had a
money as
shot.
fast as they could.
Nobody
And
had a
money was
chance to go
cheap.
ho hum.
I think that played a big part. And I went back and I looked at, since 2008, that was our last sort of like 2007 was our last time interest rates were what they were, last year, like up in the 5 to 7% range. And then the 2008 market crash brought it all down. And for some reason, I thought that when the Bank of Canada was at the 25 basis points overnight rate, that's the lowest, and it is the lowest, but it was at 50 basis points in 2009, I believe. So, we've seen a lot of low interest rate environment drive up the price of housing. But with that said, I don't think that we can get any lower for interest rates than we've already seen. So that sort of, to me, over the last sort of 10 to 14 years, sets the balance of the potential of the market. So I think that we will come back to see slower growth because the money can't get any cheaper than it has been, over that period.
Even when money was in the 3.5% range, like back in like 2017, 2016, 2015, 2016, like we're in that range, and buyers were going crazy because of the veiled threat of foreign buyers buying all the properties and people being worried about having to outcompete other, entities in the market.
FOMO is real. This is what you're trying to say?
Yeah, exactly.
Yeah.
Like people are just worried that, oh my God, I'm not going to be able to buy it. And so they were just piling on and the prices were going up and up and up. I don't know. I just don't think that income really has anything to do with it. I think interest rates are secondary. We'll have lower interest rates by this time next year. We'll be talking in the mid 3%, in my opinion, for fixed rates. But I don't think that necessarily is the lever that gets everybody back into the market. I think when there's an environment of lack, when there's not enough, that's when more people want to jump in. We got tons of buyers and tons of people asking, how much can I afford? I don't know. I just don't think that interest rates are the big driver. I think it's more just the fear of missing out. And when that comes back, and it will, because of the 1.5 million people that came to Canada in the last year, that's then going to drive the market back up.
So
So
let
Sean
me
is
ask
saying psychological effect. I'm saying material effect.
okay.
We got where are
We
you
got
at,
10
Kristen?
minutes of that argument. I want to move along to a question that I just thought of now. So you think in what, 6, 9, 12 months will be in the threes for interest rates. So when you're doing mortgages now with your clients, are you seeing people and are you now recommending, I guess, what's the feeling about taking a variable today?
Variable all the way.
Yeah.
The 3-year fixed for anybody that's feeling nervous and just wants to get an interest rate.
Mm-hmm.
But with the direction that interest rates are heading now, we're expecting 2, if not 3 interest rate cuts before the end of the year. Our very own Sherry Cooper from Dominion Lending Centers, our chief economist, thinks that the policy rate is going to be at 2.75%, meaning like we have another 1.75% of variable rate cuts to come before the end of 2025. RBC said the same thing the other day, said it was at going to be at 3%. So everybody's in that range and nobody's saying that it's going to stop there. I think that variable is the way to go, and we're going to start seeing a really steep decline in the next 12 to 18 months.
What do you think, Vaughn?
Well, it depends. If you're looking at taking the mortgage application and you use a variable rate to qualify, again, you're qualifying for less money. So it depends. If your clients have a lot of room, then variable rate 100% is a smart choice. Now, I think 2.75. I think that the Bank of Canada will get down to 2% or potentially lower than 2% when this is all said and done. We'll see a monster cut at some point. So I think that there's a lot of value in the variable rate at this point, but it depends on qualifying the client. So if they need the extra $20,000-$30,000 in mortgage amount to make that offer, then they may have to be stuck with a fixed rate, whatever the lowest rate is on the market.
Yeah, we're starting to see 2-year rates come down. We got an email from one of our lenders that they're in the kind of low 5% range for 2 years. And that's come way down, like closer to 6% was kind of the norm for 2-year fixed rates, meaning like that yield curve is starting to normalize where it was inverted before, meaning like our short-term rates had higher rates than our long-term rates. So now that those rates are coming down, we're starting to kind of go back to a regular or just a regular yield curve where rates are going to be kind of what we expect. So shorter term rates aren't necessarily a bad idea. But the shorter, the better. And I wouldn't do anything longer. I wouldn't do anything longer than 3 years. And I'm fully on board with variable rates right now. But you're right. If they qualify, great. Variable. If they don't, then it's a fixed rate.
It's again, it's the emotional thing too, right? Like there are dollars and cents, and then there's like, are you going to sleep at night? Some clients just want to not think about this, not worry about the market, just get their, just make their payments. And yeah, I haven't seen anybody take, I think I've seen one 5-year fixed in maybe this year where it was just people who were like, I don't want to do this again for 5 years. And I don't care what it costs.
Wow. I mean,
So
I'd rather put somebody into a 3-year fixed at a higher rate than I feel really bad putting somebody into a 5-year fixed right now.
that's what they wanted.
Especially when we know that interest rates are on the decline and the interest rates are high to combat inflation, and that's it. Inflation's under control, and it's probably more under control than what it looks like when we just look at the 2.4 whatever inflation number, and they expect that that's going to plummet. So I think we're well on top of that. We've survived that wave. Another headline
Well,
that
sorry, I
go
was
ahead.
Vaughn. I'm going to say,
Yeah.
I think they're more concerned now about inflation slowing down too much, getting below the 2% mark. Honestly, like,
Yeah, I mean they cranked on that lever and they
So
cranked on it
delicate.
long and
It's
hard,
like meat
and
and
this is why
temperature.
we are where we are.
It's got to be
yeah,
perfect.
it's got to be perfect. And I think like it's so hard to hit it where just like it's like trying to stop on a dime. We wanted it 2, but we don't want it at 1.8. And I think that it's going to be really tough for them to nail it because the sentiment out there is a slowing market, and overall, a slowing economy, not just the housing market, but I think the housing market is a good kind of barometer for what the rest of the economy is doing. And I think we'll see future data showing like, oh no, we've gone too much. We're going to have to lower interest rates further. We're no longer in a period where we should be having restrictive interest rates.
Yeah, and we'll see them fall as a result, and we'll see the market come back as a result. I think that we'll resume. Ultimately, we'll resume the chaos that we had a couple years ago, maybe without the drastic peaks right off the bat. But if you're right about this FOMO phenomenon, then as things start to move, things will start to move, and we'll go from a crawl to a sprint overnight.
Yeah.
So, buckle up. I'm looking forward to it, to get busy again like we used to be. It was a lot of fun.
For sure.
And yeah, we're ready to go. There's another sort of headline that I really wanted to debunk today if we had the time, and I think that we do. And this is we were hearing this from economists, we're hearing it from newspaper headlines, and this is a fear-driven headline that I don't understand, and I'll break down what I think about it. It's the idea that 60% of mortgages are going to renew in the next 3 years, and for some reason, we should be afraid of that. Now, if you look at Canadians love a 5-year fixed or 5-year variable. So if you think roughly 100% of mortgages are going to renew in 5 years, then it makes sense that 20% are going to renew every year. And then it makes sense that 60% are going to renew in the next 3 years. Now, we've already been in the worst interest rate environment over the last 2 decades, over the last 2 years. We're over that. Where is the fear to drive these headlines to get any attention to it at all?
This is like a residual headline that was worrisome for a moment when interest rates kept climbing, and then it's like, oh, these mortgages are going to renew, and I guess the worry is that the payments are going to be too much and people are going to lose their houses and people are going to default, but rates are already coming back down.
And 40% of mortgages just renewed in the worst rate environment that we've seen. So I don't understand where this headline comes from. I don't know how it draws attention at all.
Everybody wants to make some noise, and I don't know. I think that maybe now I don't know if it's a fearsome message now. I think it's a message we're getting as mortgage professionals, because it's like, don't worry, mortgages are going to be up for renewal and there will be business soon. Like, it feels more of a hopeful, nugget of like hope for us, rather than like a scary thing for like Canadian homeowners.
Yeah,
I think homeowners. Yeah, I think that I mean, if it bleeds, it reads, right? Like, I think they're trying to get people's attention, and I think like, oh, your mortgage is up for renewal, or the economy is going to fail because people are going to have to sell their houses. I think that's the kind of the underlying sentiment that they're trying to push. Like, there's going to be blood in the streets, and if our interest rates don't come down, then we're in a lot of trouble. But over that 5-year period, people's people's wages have also increased as well, 5% year over year. Now that's on the aggregate, but people can afford a larger payment, and we're nowhere near that high point. We're probably a percent and a half lower than what we were before. Nobody's renewing in the sixes now, unless you're maybe an alternative lender, you're in that environment. But yeah, I'm with you. I think that it's great, and most people end up just renewing with their bank at whatever rate is being offered, and they make it work. I think
Which is
where we
usually
are,
below market value. And not to mention on top of that, that every lender, no lender wanted to lose the loan, right? So lenders were coming up with creative solutions, extending amortizations over a short period of time, just in order to make things work. People were not losing their homes. The headlines were sensationalized and maybe based on, maybe somebody took a private loan out or something, which was predatory to begin with. And then upon renewing, the private lender didn't want to renew. So they were forced to either find a new private lender or to sell the property. But that represents probably less than 2% of the mortgage market overall. People were not losing their homes. People are not going to lose their homes. This headline is over sensationalized, and it's time to retire it.
But what do you think? Like,
I approve retiring the headline.
Approved. But what do you think? Like, every so often I get like an investor or somebody that's speculative that comes to me with that same sort of line of thinking that says, hey, in a year from now, everybody's going to have to sell their homes, and I'm going to get a better deal because interest rates are high and prices have come down. It almost feels like people they've missed out. They've sat on the sidelines, and now, they're hoping for some sort of huge decline. We're here now. Property values have come down, and we're not seeing this some sudden rush of people coming in. I just to think like a tsunami of listings hitting the market because people can't afford their mortgages, I think is unfounded and dumb.
I agree. Yeah. Trust the facts and not the headlines.
There you go.
We've got the data for you.
I remember, Vaughn, that you wanted to talk about the price of condos coming down, and I came prepared with one fact.
Oh, let's hear it.
I think I just have to share it, or else it's going to be for naught. I did all this research. So you were talking about
5 minutes worth of research
on an offside, if that. On an offside, out of the podcast conversation, we were talking about prices dropping. And then I was looking at that article you kindly shared, and it was like, here's the average price for a 348 square foot condo. And I'm like, prices coming down in condos when we're building tiny shoeboxes, like tinier and tinier shoeboxes. I was more interested to see what the square footage change was. So condos.ca actually is something, I don't know if you've ever even heard of that. They can be a sponsor later on when we establish ourselves. But I was checking, they have like square footage over time. And so square footage right now in Toronto for a condo is $828 per square foot. And that's down 10% year over year. And the highest time for square footage in condos was February 2022, where it was $1,069 per square foot, which is outrageous. It's so outrageous. So anyway, I don't know if you want to keep talking about that, but now you know the facts.
So is it the type of property that's selling as well? Like, are there less kind of luxury buildings that would have higher cost per square feet that's selling?
So it seemed to me actually that the luxury sized ones, sales haven't changed too much, which the people who were going to buy a 3-bedroom condo were always going to pay a ridiculous amount of money for those condos. And those people always had the money to do that. It's more the studio 1-bedrooms, I think that are really, those are the majority of condos.
And I think that's what's sitting on the market right now as well, are those. And maybe the cost of square foot has gone down because perhaps the amenities available in those buildings have decreased. There's probably more to dig into it.
Sure.
Even though the stats tell a story, a lot of the times the stats tell a story that really what it should be telling us is, oh, we need to dig a little bit deeper in here instead of looking at one set of numbers and making our final conclusions on it.
Yeah. Well,
Yeah, because it's
that's every stat that we see in any publication is really just an invitation to do some more investigating.
Yeah, it's that price per square foot. It's probably come down because investors have left the market because of the change in the capital gains tax, because that's no longer a good long-term, in the short term, it doesn't seem like a good long-term strategy. A lot of investors have gotten out of the market. That's what's going up. Those studios, the one bedrooms. It's not like the 3 bedroom in Yorkville is necessarily dropping at that same rate.
No,
But
and
we're
you
seeing a
have to
lot
think
more of
about
the
the
smaller.
necessity or the need.
Investors, right?
Yeah, like when you think about the need from the buyer's perspective, if you're buying a 3 bedroom, it's probably because you have 3 bedrooms to fill. It's not speculative. It's a different purchase than a 1 bedroom condo in the financial district that you're hoping to rent out to either a student who's close by or somebody sort of new to the Bay Street financial district that needs a place to live. So two completely different set of needs for buyers. We shouldn't think of real estate as this commodity that we trade and transfer for exclusively for profit. It's a place that people have to live.
Fun. Look at you. Look at you and your small
Just
L
like trading
logo.
places today.
I love it. I just jumped into Vaughn's brain, guys.
What happened here? I mean, I've said that from the
It's
beginning.
so
Now,
refreshing. No, honestly, it's really refreshing to hear people in finance and in our business talk about, like, we all want to feel good about what we do. And a way that I feel good about what I do is I feel like I'm helping people get housing. And I want all people to get housing, not just people who are rich or who can make me money. And I'm kind of anti-investor at this point. I feel like investors have bought so much of the market that it's increased prices and it's priced other people who want to actually live there out of the market. So I love these small things that have happened over the last period of time that have made it less attractive and made it less advantageous for investors to own a portfolio of investment properties. My 10-year-old asked me if being a landlord was a job. And I said, I mean, it kind of is. And he said, I want to be a landlord when I grow up. And I was like, well, here's the scoop about that. And he was like, oh, never mind. That sounds bad.
now I'm not anti-investor at all. I think that there's a time and a place. I mean, I'm happy to help investors out with purchases. People need to build their retirement plans, and that's an important part of our job as well, is helping them navigate
but consider that on a deeper level. Your retirement plan is that you're going to take a renter's money for housing. Like on a philosophical level, there's some depth to dig in there, I think.
Well, people need to rent. When people are maybe new to a city, they need to rent. There's a ton of, some people prefer not to bear the burden of ownership.
Sure.
That's for them to decide. We do need more rental properties in the GTA, and we needed all of that investment income to get these condo buildings built. I mean, we've talked about it on the show before, and I think that it's a absolutely perfect scenario. We needed all that investment capital, and we got it. And now that things aren't as favorable, now Canadians are going to get access to buying these units. I mean, I couldn't think of a better scenario.
I could think of a better scenario, but we're running out of time here.
Yeah, but I think there's a gap. I think there's a gap between somebody, like, we haven't built enough purpose-built rentals, apartment buildings for rent. And now that we've built it all through privately, there's still a gap for people to jump into the market, right? So if you're going to purchase a property, you need that 5% down, or, if it's under 500, or, minimum down payment at least, if not 20% down. But then you've also got land transfer tax. Then when you sell the property, there's realtor fees, and you're buying another, there's land transfer tax. So that jump of being able to go into one of these 1-bedroom condos as a first-time home buyer, that's a big jump because there's all these other costs that are involved. I don't know. It's not just about, hey, now we've got all these investor properties hitting the market. I think the gap is there because, well, how long am I going to want to live in a 1-bedroom apartment for? That being said, you can build equity, you can pay down your mortgage, you make, you're paying probably $30,000 a year in rent. That can go to better places, but there's a gap because there's these built-in costs to get people into the market.
And we also have an inventory shortage in the rental market and in the resale market. We have more people than we have places to put them. So until we resolve that issue, we'll continue with this cycle, and hopefully we'll see opportunities like this where investors are leaving the market, which frees up opportunities for Canadians to buy property if they choose to.
Absolutely.
So,
do we have any
final
more games?
comments
We
for
have no more
today?
we don't have games today. We just had lots of chatter.
Banter.
Banter. Sorry.
I guess I had one
Into that reel.
approve or decline based on our first conversation. Is that, will interest rates come down to encourage more buyers to purchase these condos? Or will wages come up to help them out, to borrow more money? Or will prices come down? Or will we meet in the middle somewhere? Kristen?
I don't see. I don't see wages never come up as fast as people need or want them to. Although, yeah. But I think, I think as interest rates come down, for sure, people who have been making an emotional, doubtful decision to stay on the sidelines are for sure going to want to, they're going to get that FOMO like Sean spoke about. So that's not an approve or decline. That's comments.
I'm going to decline across the board. I'm going to send the deal back. I'm not interested in this one. I don't think wages will come up. I think wage growth is slowing down. It is slowing down. And property values will not come down fast enough where we will have that meet in the middle. I just think that it's not realistic for that to happen. I think when FOMO kicks in again, all of a sudden people will be buying condos, and it will have nothing to do with how much they cost or how much people make.
And I'm going to decline based on we're not going to meet in the middle. That's always like, that's the idea of the balanced market that that I don't believe in for the GTA anyway. I think that what's going to happen in the next 18 months is mortgage rates are going to bottom out again. People are going to be able to, afford a mortgage plus a bit of lifestyle. And that's what's going to bring the market back.
All right.
Well, we'll see.
All right, let's meet again in a couple weeks. Kristen and I are on vacation next week. So if you're watching and you're hoping for an episode, I'm sorry to break your hearts, but we will be back in a couple weeks with another episode of Mortgage People.
Bye-bye.